I appreciate it. Thank you, Marty. Great conversations this morning, then, both on ESG and then just what we had on venture capital. We're now going to move into private equity, which, in many ways is further upstream from venture capital, right? It's still equity investing. It's still capital raising for companies. It's all the same things in many different ways. Just to give you a little background on sort of the atmosphere going on right now. PitchBook spoke about the VC PE outlook for 2024. Some of the themes they in their analysis was, positive economic signals through 2023 will spur a comeback in IPOs in 2024. U.S. Venture capital fundraising is expected to increase, making it a stronger than 2023, but comparable to 2020. So it's not the heydays of raising capital. U.S. active unicorn count. So these are high, fast growing companies, the unicorns. Count and aggregated post valuations will decline in 2024, which is interesting and something to be thinking about. Flatter declining interest rates in 2024 will lead to an increase in VC deal activity with non-traditional VC investor participation. So just a couple things for you to keep in your mind. Morgan Stanley had its own version of the M&A market. I'm just going to touch on that because we'll be touching on that a little bit here. And I know the next panel is being run by Daniel, and he's going to be talking a lot more about M&A. Three areas that they're expecting to see more activity in, and we've touched on all of them this morning already: energy, healthcare, and technology, particularly AI. So we'll be speaking about those. The return of financial buyers, both as buyers and sellers in 2024. So we'll be looking to see, the private equity shops take interest in those venture capital companies that are being developed by the VCs at the earlier stages. Activist campaigns, which we had an activist on yesterday, pushing for more M&A solutions. So again, we had a conversation yesterday, we'll pick that up today, with about going private. And when should a company go back to being private after being public? Corporate separation activities will continue in 2024. We'll see more of that. And regional economic woes will drive cross-border transactions. So you're a company based in the United States, you might be purchased by somebody outside or do most of your capital raising from outside the country. So some interesting topics, some interesting themes. And thank God Marty is in charge of this thing and puts together great panels here. So we have Gary Post, who's here on video behind me. He is with the K Funds, which is a fund manager backed by multiple family offices. So we're going to be interested in hearing from him. Peter Toth is sitting here to my right. Bill. Oh my gosh. Peter was on the last panel. Bill's on this one. He is managing director of Queen's Giant Investment Banking Firm. And to my left, we have Eric, and I'm just going to let you say your last name.
It's Perlmutter-Gumbiner, but just Perlmutter.
Comes out so quickly and smoothly out of him. My name is Mark Heil. I'll be moderating this panel. I'm a managing partner with Pickwick Capital Partners, a FINRA registered middle market companies and alternative assets funds, providing strategic and transactional services. We provide the full range of investment banking and fund placement advisory services. For the next hour or so, we're going to be having a conversation about private equity. I invite you to be part of it. And based on what we saw a little bit earlier, I'm sure that's going to happen. Don't be shy. Just yell out. We'll get you a mic if you need one. But, be part of the conversation. Be part of the flow. The only thing I ask is time is valuable up here. So I ask that you keep make your point and get to your questions quickly. With that, I'll go through the quick disclaimer here. Information is presented for educational purposes only and is not intended as and may not be relied upon as tax, legal, or investment or other advice. To the extent myself or any of the panelists express an opinion as part of this discussion, they are personal opinions and not necessarily those of their firms. So with that, let's get into some introductions. I've mentioned everybody's names, told you who they're affiliated with. I got 1 out of 3 right, so give me some credit. And what I'd like to do right now is have Gary talk about yourself and the K funds, give a little bit of background if you would.
Yeah, appreciate that. Thanks, Mark, and special thanks to Marty for having me here today. The K Funds is now 10 years old, and we were started in an unusual way with a group of families coming to me and said, we want you to manage private equity and venture for us. I didn't have a fund, but their advisors didn't seem to find anything on the marketplace they wanted, and they said, no, you do it. And I asked them, what do you want to do? They said, we don't know, but we know you do. So that became the K Funds, started in 2014. We've remained true to the family office space. We now have over 30 families investing with us. We're on our 3rd fund. We like to invest in companies that use information to do things better. We really love the climate as it's evolving for this. And we also provide individual opportunities such as co-investing with us in Epic Games or SpaceX. And we're still doing the same. So we're at one point diversified because we're in many industries. On the other point, focused using information to do things better and hopefully improve our lives.
Fantastic. What led you to focus on growth equity?
Well, we started with about as broad a charter as you could. We could do everything except invest in public companies. And we realized along the way during Fund 1 that the best risk reward place for us to be for families was to be in growth capital, which we've defined as a good Series A with proven economics and such, and up through and including SpaceX. As a pre-IPO company, we thought we could develop 25 direct positions, maybe invest in a handful of funds. And this was the best way for us to manage risk on behalf of the families, many of whom this was maybe their only fund they were going to invest in. So we took advantage of being in syndicates with other sophisticated investors across a range of industries. And we don't do startups and we don't leverage companies. We're here as risk managers to give families a participation in the markets. And oh, by the way, growth capital has been the #1 asset class among private sectors for the last 15 years.
Fantastic. And yeah, you really touched on, why family offices should go through a fund like yours as opposed to trying to do it on their own. But is there anything you'd like to add on to that?
Yeah, don't do it alone. I just repeat that as I don't mind having a sleeve if a family has enough money and they have a sleeve of kind of mad money that's maybe 10% of their involvement in private equity. And yeah, okay, knock yourself out. But most families are ill-equipped to source, analyze, or manage. So they're adding substantial risk to their portfolio by lack of the ability to source and manage. We have an interim route where if they're in the fund, we give them rights to co-invest with us. So there is a sense of involvement. Yeah, I'd like to be in Epic Games. Yeah, I'd like to be in SpaceX or Blink Health. And so that's a way to allow participation. But probably the worst thing for 90% families plus is to try to do their own direct deals.
Well, thank you for that. Phil, I want to move over to you. Tell us a little bit about Queen's Giant and why you founded it and what it focuses on.
Oh, sure. Thanks, Mark. Yeah, founded the firm about 5 or 6 years ago. My background has been split between sales and trading and investment banking. I've been doing it for, I don't know, maybe 30 years. And it's been, I think this is the 3rd firm I've been a principal. And so I've always been more of an entrepreneur within the space. I worked at some larger institutions, but really I didn't like it, to be candid. I thought there was a conflict of interest sometimes with the firm and then the client. And I was always in a client-facing role, and I didn't like to be in that situation. And then there was more of a short-term focus, I think, when you were at a publicly traded company to meet your numbers for the quarter, when realistically, that's probably the biggest conflict with client interests is that their term might not be the same term of the firm you're working for, right? So they also tend to pull the plug on things at the wrong time. I think you're going to see that, in investment banking, right when deal flow starts to pick up, they're finally exhausted because they're looking in the rearview mirror and saying, hey, we didn't make as much money as we should have in 2023. Then they lay off people right when they should be adding people, right? So, my view has always been that it's better to have a partnership model in what we do than being in a publicly traded entity. That way we're aligned with our clients. And we decided that we were going to stick what we were good at. I've done this before. We're good structured finance people. We are worked with some of the best people that maybe ever been in the industry on that subject. And I believe me, I would like things to be a lot simpler than they are. It would make my life a lot easier, but that also creates a need and a value to us for our clients. I'd say we'd love to do business with more family offices. I think a lot of these deals that we're looking at are pretty much acyclical. They're good deals no matter what market you're in. The big institutions like them a lot, and we can't always get the size for them. So we're always looking to work with more family offices.
And what role typically does a family office play in your investments since you do structure? Do they come in on the equity side, the debt side? Are they bridging the two sides?
Yeah, I mean, what depends on whatever, that they think is the best part of the deal. And, for us, even though this is private equity panel, I think that the private equity opportunity really at now is because the cost of debt is so high, right? So you're seeing people that are weaker going to get fleshed out, and you're seeing people that are stronger that may not have considered an investment because they don't need you asking for money, right? So however, if it's a good deal, you just want to participate the best way you can, but people that are in a good spot are not easy to, they're not going to give away the farm. So I'd say, the easiest one is to do indirect through certain investments that we have for funds we really like that are emerging. And they're just not quite ready to go into institutional space because they're not that big. But that's where there's more spread that be taken out of the trade, right? Growth equity is a great example, which is a great sector. I love that sector. And you get it's just not it's not big enough. It's the disclosures aren't there for institutions, but the yield is there and the company is a good company. So we don't really care how they play it. We just care that it's a good deal.
Perfect. Eric, I'm going to come over to you. And Eric is with a law firm. He is a lawyer. Surprise, right? But he unlike a lot of attorneys, are very much in the deal market, very much understands what's going on. So Eric, with that, I've set now a high bar for you, I hope.
Well, I guess both the
Serious.
high bar and then the typical insult towards attorneys. So I'll take it. So I'm at Greenberg, Glusker in Los Angeles. It's a full service firm. My practice focuses on a mix of venture capital, private equity, and regular M&A, and then some fund of funds work, helping family offices deploy capital into private equity funds. I've done the full circuit of all sorts of private equity roll-ups in industries that are interesting, like software and tech, and industries that are cash flowing, like HVAC. And then probably some of the sexier stuff, so to speak, that I've worked on is the sale of Barstool Sports to Penn Gaming, which was the first purchase by a gambling company of a digital media company, and then the sale of Barstool Sports back to its founder afterwards for a significantly more interesting purchase price. And then also Skims Body, Kim Kardashian's clothing company, has been a client that I've worked on from literally doing the formation documents through their 9-figure fundraises.
So it strikes me as very interesting, particularly esports and how much, my son loves it, first off, right? He sits there, he's in his 20s. And he says, oh, I want to go to Madison Square Garden and see these guys play. I'm like, but they're playing on a computer. Talk about that. How did you form that relationship? What was it like during that sale? What were the key metrics and things that people were looking at, if you could?
And so Barstool is separate from esports, but in esports, we've worked a lot with a company called 100 Thieves, which is one of the leaders in that space. Their principal Nade Shot is his gaming name, is one of the most popular gamers. And through that, I think it was our expertise in entertainment, because a lot of this, it starts with esports and it's, the gamer playing on the screen, but where these companies really make their money is in all the partnerships that they spin off from that. For example, 100 Thieves, founded with Matthew, Nate Shot, an energy drink called Juvie, which they just sold for a significant portion. And so while folks aren't really sure yet necessarily how to monetize the esports themselves, these people are very popular creators, and folks are really adept at monetizing that.
Well, it does seem like some of the traditional models of sponsorship and advertising are doing very well, and these guys are really influencers in terms of what they wear and things of that nature. It's a lot of money all of a sudden. It reminds me of the WWE in a lot of ways, in a way that business is growing. But I want to just shift and really get into our program here. Phil, M&A in 2021 was really strong, high, doing very well. And in 2023, not so much. So what do you foresee in 2024?
For M&A, private equity, or both? I would say that 2022 and 23 were really, really tough years for us in the transaction business. Most namely because of the moving target with interest rates. And I think unreasonable expectations from people looking, not really playing catch up with where the clearing price was, right? So getting stuff done was a nightmare. When things fall apart, like they did in the subprime, those were like the best years ever to be in the transaction business, right? Everyone wants to think that they guessed the bottom or the top, but for us, it was great. Shortly thereafter, it's typically the lead up for when there's a tightening schedule and no one really knows when the Fed is going to stop. So now that we have a stationary target, or the optionality might be for lower financing costs, there are deals that can get done. No one wants to stick their neck out, I think, as an investor until they get some idea. Think about the environment we're coming out of. We had 15% inflation, and we still have high inflation. 15% inflation, what investments actually look good in that environment? And the answer is tips, right? Index inflation, there are very few. So deal activity, I almost think that the posted numbers are inflated, right? I really do. I believe it was very low. If it was, a lot of people that did deals regret it. And now you're in a completely different environment where, the deals that should never have gotten funded are being exposed. And to me, that's a tremendous opportunity for someone that's an investor. And we're speaking to mostly investors here. For corporations, it's also an opportunity because their competitors might be in a weak position, right? And I can go, you want me to go specifically on a couple of things I think would be opportunities, I'm happy to do so.
Just quickly.
Yeah, real quickly. So I think getting good companies right now where they would never be looking for capital unless it was so expensive. I think that's kind of like low hanging fruit, right? Roll-up strategies that go into the M&A you talked about, where that same company that might consider an equity investment that never would otherwise wants to go buy their competitors. And another one, right? Buying out, giving liquidity to LPs, huge, right? A lot of LPs want out. No offense to the VC guys, but let's just say that if I had $1 for every VC looking to liquidate right now, I would have my own family office, right? GP stakes, you could buy out GP stakes at the time. Roll-ups all across the board and very poor decisions that some of the asset managers were making. And for me personally, I'm glad that I'm not being yelled at anymore when I say it, because I had a bad feeling when they were buying these investments that they were not going to work out. And then I would say, kind of for something we're working on, I think, some of these acyclical industries, because we might be going into a recession, are really, really looking good right now on a relative value basis. And I don't know, I think that sums it up.
Yeah, I think we'll wrap it up there. We'll land it. And Eric, I know you had a comment in the middle there, so why don't you?
Yeah, I was just gonna say, Phil, I think I agree with you, especially on the valuation point that you made, that a lot of stuff that was kind of overpriced and not attractive a couple years ago. I see a lot of those same companies, out back in the market at a much more attractive and favorable price that I think is something that makes sense and it's gonna open up deal flow.
One of the things I was curious about is, when valuations when the bid and ask price are so far apart, it leads to a lot of creativity for lawyers.
That's how you end up with things like earnouts, seller notes, sellers rolling over equity, all sorts of things that I think you can do to help, bridge the gap on purchase price. And ultimately, I think help both parties share the risk pretty fairly.
And I agree with that too. If you're creative in this market, the optionality might be for a lower rate environment to give a little bit extra juice to it. That's really where we can earn our fees, right?
Exactly.
Yeah.
Gary, can you guys also add in the ingredient of the bank pullback and the impact on that? Because I think banks have pulled back, credit lines like crazy all over the place, right?
Again, more creativity for the attorneys, but also in the financial market.
You've gone from
Maybe you can
80
address
to
the opportunity.
65% advance rates. I mean,
I'll give you a
yeah.
great example,
Oh,
okay? I
huge.
had a guy come to me and he said, Marty, I bootstrapped a company to $400 million in revenue. And I got a call and I've got $30 million in the bank. And I've got a call from Chase and they're reducing my credit line by from 60 million down to 30 million. I gotta get them all the money I have in the bank. I need some capital, right? This guy never would have gone for equity because he owned 100% of the
board.
company.
No, across the board. And, baby out with the bathwater situation, which is good for investors. Like I said, that creates that need for equity shortfall. The banks were and others were making, incredibly high amounts of leverage initially, and now they're regretting it. They're pulling back. There are risk weighting requirements that are coming down, the new rules that are going to actually, it's like the regulators are always, behind, where they should be, doing something to help these banks. They're actually piling it on. So they really aren't in a position actually to make these even adequate amounts of leverage if they wanted to. And we're working on stuff with zero risk weighting, insurance stuff, which is also a sector I like, insurance, but, and the banks won't lend against like an insurance pump. I mean, it's pretty bad. The liquidity is pretty bad on the banks. Yeah.
Hey,
Sorry.
Gary,
Yeah.
I want to
Yes.
pick up with you and just maybe, we had a nice overview on the transactional side of things for 2024. Maybe you could speak to the growth equity space and what's going on there in the venture space a little bit. I know we just had a VC panel, but maybe you could fill in some gaps here on what's happening in 2024 in that space for us.
Yeah, I would be happy to, but in the manner of managing risks is we don't deal with banks on anything. We don't deal with government on anything. We're trying to eliminate those risky elements for our investing. I'm sorry, hopefully nobody is listening out there to this private conversation here. But we're seeing a gangbusters opportunity in the current market. I think a lot of people are familiar that funds that invest coming out of economic downturns have proven to be, over the last 20, 25 years, to be the best vintage years. And we're looking at that, and we're also being boosted by artificial intelligence. We'll perhaps talk a little bit more in detail about that later. But again, the thematic, using information to do things better, is like supercharged by the application of artificial intelligence. Also points fundamental. Innovators innovate. Lots of dry powder. You can't stop this in America. We're going to have innovations. We're going to grow companies. We are going to do things better. And again, our fundamental principle is investing in companies that change the way things are done. So we're looking at, in our sector, we're looking for, a nice several years in front of us.
So are there particular sectors that you're particularly excited about right now? I know you mentioned AI, but are there some others?
Yeah, AI is pervasive. And it can be used in almost any industry. We've used information technologies for wholesale grocery, generic drug distribution, property management. All of these industries are ripe for revolution in how they do things. But if you look at like artificial intelligence, it's just one element of what goes into information technologies. So things we really like is the healthcare sector where information meets healthcare. It's not, we don't develop drugs. We don't plan to do that. We don't do biotech. We don't do any of those things. But the way healthcare is organized and managed will be dramatically changed. And we already have some investments in that space.
Give me just a second. Gary, one of the things you mentioned a little bit earlier was SpaceX, and I know in our prep conversations, you spoke about why you got into SpaceX, and it's a little bit different than what most people might imagine. So would you speak to that?
Sure, be happy to.
Also,
First
the
of all,
timing of when you got in.
we got into it because we were doing a favor for somebody. We had kind of a space addict nod, said, how can I get into SpaceX? So we made a few calls. We found a way in. It's hard to get on that cap table. We went in on a joint venture basis with a childhood friend, one of the management people. And as we got into it, we had no interest in the launch business. We don't want to go to Mars. We don't want to fund going to Mars. But what we found is Starlink, which was SpaceX was maybe a launch company then, but it is on its way to being a massive telecommunications business. And we said, aha, Verizon has a market cap of 300 billion. SpaceX, we're 5 years ago in SpaceX, 5.5 years ago. And we said, this company is going to be a better company than Verizon. And so there we go. That's what we're going to do.
Mark, I know you had a question.
The $20 billion Adobe Figma deal got squashed about a month ago. Could you just touch on regulation, especially cross-border regulation? I think the British sunk that deal, and yeah.
You want to field that?
Yeah, I mean,
The attorney, he's very, especially international, right?
Yeah, of course, yeah. I mean, I think I can speak more generally in that regulation is obviously increasing, especially in the healthcare space right now. You know, there's a deal that I'm involved in where if we don't close it in the next couple of months, it's not going to happen because there's some very, very strong, anti-competition laws taking effect in California. And so I think it's something, that kind of ebbs and flows, obviously, with the political party that's in charge. And we're in a position now where, there's more regulation coming out of that.
You also mentioned some regulation in the healthcare field and the acquisition of physician programs and how that's affecting the deal you're working on.
That's correct. Yeah. In that space, there's obviously a lot of consolidation going on, which is not necessarily great for the payors in that system. And so, there's a push, I think, to kind of create more different physician groups that are independently owned in a way in which you can actually get competition and not hold the payors over a barrel.
I think investors are very familiar with the idea the government giveth and the government taketh away. So it's just more of the same.
So, and I want to get back to Gary and also to Phil, which is that I think with space, there's like a Cambrian exchange or explosion of technology that comes out of it. I mean, besides the telecom aspect, there's a material science aspect, right? And then there's a robotics aspect to it. So, I'm hoping that maybe, Gary can get into that. But at the same time, as you said, people don't stop innovating, and stuff that used to be venture maybe is now looking for private equity. It's in that growth phase. And I'm hoping that Phil can talk about new opportunities that he sees. I mean, the stuff that's going on in sports right now, I had a company talking about platforms who came to me. They said, we're the leading distributor of sports ticketing for youth games in the world, right? And they sold 2 billion tickets last year, making $20-30 million. And they think that there's a tremendous opportunity being able to aggregate their purchasing strength to buy kids' uniforms for gaming, for example, right? So, that's a platform, right? So maybe you guys can talk about those kinds of opportunities too.
Oh, yeah, I'm happy to do that. So a couple of things I really like, and I think we spoke about this, is this NIL. I think this NIL thing is ready to explode.
What is NIL?
So name, image and likeness for student athletes in college. They changed the rules so that the players can get paid, and the way that it's set up is that, they can't get paid while they're in high school. And so if you could figure out what the market rate is for a quarterback or something like that, you could actually get the kid in advance while they're, and a lot of these kids need the money, while they're in high school, and then you're secured by the rights. You could pool up all these rights, and so one of our clients is doing that.
So you're talking about like 4 and 5 star athletes.
4 and 5-star athletes, and it's a growing and event. We think that's very interesting, along the sports side. This is sort of a positive thing. Another one I like is, housing is so expensive. I think affordable housing stuff, that was another one of the panels here, but also specific to something that we're working on in manufactured housing, where it's like they don't make enough of these homes. I don't want to necessarily live in one, but a lot of people do. And it's relatively better than what their quality of life would be doing something else. Tremendous backlog and demand for that product. And the way you finance it, we're actually working on something for tearing down aircraft parts, where you could look at the demand for aircraft parts. It's look at it 20 or 30 years almost in the future, because you know how many of these parts or engines were built, and you're going to know the demand for the parts. And it's pretty much acyclical, right? So our particular client in that case also has gone through the cycle, right? Where, you've gone through COVID and you still made money doing something. And I mean, that says a lot. And, we might be going into a recession, but doesn't mean there aren't creative. I think this is what some of the panelists were saying. There are creative people out there doing really interesting things, right? And it's not really a secular trade. It's just a good investment. Those are a few that I like.
Gary, do you want to chime in with a few more that you're interested in? And then also maybe tell us, when you're looking at an investment opportunity, an investment candidate, what makes you want to invest in them? What are the important key factors there?
Yeah, first of all, we're looking for companies that make a substantial change to the status quo. And the second thing we look at is substantial changes to the status quo. And then after that, we're looking for market size opportunity that's reasonable, related to the valuation, capable of growing without a lot of extra money, not globs and globs of money. So for example, hardware plays like mobility and such that are the hardware side take a lot of money. Companies need to have product developed, need to be in the market, have referenceable customers and such. And we're also very sticky about understanding the unit economics of a business. We want to know, are they really making money, or there's somewhere in the accounting structure, say for a software company, that has R&D actually supporting negative cash flow at the product level. So the other factors, like who else is in the deal? We're about minimizing risk, and hey, if we see Andreessen Horowitz or Mayfield or somebody, well, yes and no. If we see some smaller funds that we know personally, we ask sometimes for their investment committee. Say, yes, send us your investment committee memo. And that's another part of deciding, what to be in.
Bill, do you have some more that people don't think of investment bankers as doing diligence on companies, but they do, because if you take out a bad deal,
I do.
right?
I do. Yeah, you got to vet. I mean, we don't expect, us to see everything when it's someone else's money, right? They tend to be the smartest person in the room is the one putting up the money, right? Like, whose capital's at risk. But I think this we have a few things going on in the insurance sector too there's a lot of creativity going on in insurance. And I think it's interesting, right? I mean, they're just non-market correlated, really nice return profiles with a high yield environment where I don't think you regret it. I think you sit on that thing and you just, you look and you go, wow, that was easy. Right? I mean, you know, at some point you got to move your money out of 5.5% overnights and lock in at 8% and you just keep it.
I just want to jump in here. So I was talking to Ron, to Bob Bozeman, who's Ron Conway's ex-partner. And anybody who knows the SV Angel Fund was that the first fund was amazing because they had Google in it and they invested, I don't know, $200,000 and came out with 30 million from that investment. But the second fund came just before the market crashed on the internet in 2001, and they had litigation for 5 years, right? And Bob came to me and says, you know what, Marty? In hindsight, the easy ones are the ones you should take and forget about the ones that are hairy. Any thoughts on that from a deal point of view? I mean, because I think you kind of just said it.
I mean, you know, sometimes it's just, you're in the right place at the right time and it's better to be lucky than smart. Just been my experience of doing it for 30 years, right? You know, people who, you know, I would love to hit a moonshot myself, you know, I mean, but I think that, you know, something where you look at an emerging thing, like we're talking about NIL rights or something like that, where you're coming early, you could make a lot of money, like a SpaceX thing, but there are other things where, you know, you throw it in there and say, hey, look, you know, I mix it in here. It's asset allocation. I'm sure that everyone can understand that. But yeah, there's some really, really good investments like in the housing stock, like I said, with manufactured housing and just some insurance products, you know, to maybe even a more of extent. I mean, we're talking about, you know, demand for aircraft parts, and we already know that 20 years in advance. There are really smart ways of playing it, and it's not like you're sacrificing much yield. I mean, you know, to do it, but yeah, mix that in with maybe some earlier stage companies and you're probably looking good.
Hey, Gary, any easy ones in hindsight? Have you done any easy ones, like ones that you said, this is easy and you did it and it was as easy as you thought?
Yes, as a matter of fact, and it started with trying to do a favor for somebody. So we had a small investment in another fund, and I knew what they were doing. I had an idea for them, an investment idea, and I called the portfolio manager and said, "Hey, we've got this company here. We heard about," and they said, "Well, Gary, you know, we just lost money in a company that's similar. But as long as I have you on the phone, would you be interested in a company that's going to close in 3 days? And you have to pay it in 3 days." I said, "Well, okay, tell me what it is." So it told me what it was, and it is a company I was following for 18 months. And they were doing a settlement with one of the dispute between the founders, and that company was Ripple Labs. And it was a President's Day, and I made one call to an investment committee member, and I said, "Yeah, we're in." Yeah, that was easy. And not only did we like the company, but we had some special information they could share about the situation, which made it like a no-brainer. So that was pretty easy. That was easy.
Always love easy. Steve,
Can you expand, Phil, on your business in the aerospace segment? Because we're involved in that. I'm curious
It's
more
really a
about
client
that.
of mine is actually, yeah, I'm happy to introduce you to the situation.
Expand on the whole thing. You know.
Yeah, I'm not an aerospace expert. There are a couple things that we're working on in the space. One is more of a venture capital investment where it helps with better routing so that there are not these things going on in the air, but also prevents, there's another part of it, which is almost like an intelligence play where it prevents jamming, which is going on a lot right now in the war in Ukraine and Russia. That's one that we're working on. And the other one we're working on is basically advancing money to people to tear down parts of aircraft engines and things like that, and then sell it. And one of the interesting thing about that one, I think, is that the OEM is actually involved. So there's superior information on demand for those parts and actually the tear down of the aircraft. So it's, to us, when we look at it, and we don't know exactly as much as the person doing it. Okay, and I'm happy to put you in touch with them. But from our perspective, this is, you know, for the type of yield profile here, and it just, with the OEM involved and superior information that we possess in this case, that it's just a solid investment. It's also structured so that you get your money back first. And you don't have to inventory the parts and take that risk to sell down, which to me seemed like a very attractive investment.
Well, that's great. And you two can follow up afterwards and continue that conversation if you would. So I want to turn back to the topic that Gary raised about AI. And I know all three people up here have touched this industry and have a lot to say. But I know Marty's also getting the hook ready up here. I saw him extending the cane a few minutes ago. So Gary, talk to me a little bit about your strategy for AI. And do you see this as, I guess you see it as something real, given what you've said about it already. But what role might it play, not only in healthcare and other industries, but within the private equity industry?
Well, and from the venture through growth capital, it's an excellent opportunity. It makes what we're doing in information technologies even better. Our strategy has not been to go too much after the big, large model companies, although we did invest in Anthropic. Our strategy is to, one, do picks and shovels. So we're in a company called CoreWeave, which is supplying the computer power to do the massive amount of computing you need for AI. And that company has a special relationship with NVIDIA that gives them a powerful advantage in the market. Otherwise, we're looking at point solutions like as simple as making the physician's life better by streamlining the process. Some people call it a co-pilot. Same thing for patients. It's point solutions to help do things, and there'll be many of those.
Thank you. That's terrific. Eric, one of the things I want to ask you about is, your clients come to you and they have AI investments that they're making. What sort of concerns does that raise for you?
Yeah, I mean, it raises a number of concerns. I mean, it depends on the type of product, but something that's come up often is, how were the models trained and where did they get that information from? There's a deal that we worked on recently where somebody was buying a client of ours that had large AI models, and it turned out that all the information they had scraped wasn't theirs and didn't have any ownership to it. And so there was a big fight in the deal process about how to allocate that risk. And so that, I think, is something to really pay attention. It's really industry specific, but there's a lot of both regulatory and IP issues that touch AI.
Well, I think data streaming, getting the data and where that data comes from, how they're sourcing it, and what it has a huge impact on the quality of information coming out of it on the other end.
It's not just that, but I think kind of most famously in my industry, you've seen attorneys try to use ChatGPT for legal research, and ChatGPT will, to a fault, give you what you want, which means it will make up a case if it has to prove your point. And there was an attorney in New York, I think, that got disbarred because he was using made up cases from ChatGPT and didn't bother to check to see that they actually existed.
It happens all the time, right? Unbelievable. Gary, you had dinner last night. I know that you had an interesting discussion, I'm sure, about AI. Any thoughts to throw in here on sourcing the data and due diligencing an AI company?
Well, this was indeed a dinner with an AI company. They were applying AI to portfolio construction and management for, let's say, family offices. And I challenged them. I said, here's a portfolio, go do. And I'm waiting for the results to happen. But it's a little scary. I'll leave with thought is, if you want to really get scared, you can watch a film that was made before probably most of the people in the room were born, which is 2001: A Space Odyssey. I won't tell you about it, but it is as good an issue on AI as I think I've seen.
Let me ask you, so did you get in a conversation about where they were pulling their information was, how much of it they had? Because, you would think that in a family office space, that information would be hard to come by. And to get enough data to really make intelligent decisions and to be a learning curve for it. And maybe obviously I don't know what the company is or what the model is, but I'd be very curious about that.
Yeah, well, they've outlined part of what they have is certainly they want well-defined inputs, Like, what's that for, the desire of the investor? What are they trying to do? What do they need? What cash do they need? In other words, some investor inputs. Okay, on their side, they have access to a tremendous amount of data in the public markets in more general terms of what's going on in the private market. I'm a bit skeptical, and I'm not sure I would take a human's hand off of the tiller completely, but might like to look and see, well, what is this artificial intelligence actually coming up with, and how does it compare with the sensibilities of, let's say, a financial advisor? And that's exactly what we're doing, and I'll let you know in a couple of weeks.
So if it comes back, it says, invest in K funds, or are they getting an allocation?
Yeah, oh, well, yeah, maybe, but I'd probably chop the whole thing off and say, how would they ever know any information for that? But it will be interesting to see, because it's something I know a fair amount about. But as a thought on AI, for the time being, I wouldn't take the hand off of the tiller by a human, but I think it can be extremely helpful in things that also aren't mission critical or life threatening.
Bill, I want to just shift topics here now. Yesterday, we had an emerging manager by the name of Alex Silver of Annan Capital speak, and he was speaking about, when it makes sense for a company to go private. And I wanted to get your thoughts on when that makes sense, when to take a public company and then actually take it back and being private. And maybe, Eric, you can, if you run in that situation, you could throw in some additional thoughts.
Oh, sure. That was for me, right?
Yes. Yeah.
Well, it was similar to, I was speaking to earlier, where in a public company, you tend to be short-sighted, right? You're going from quarter to quarter, and I've been on the other side where, we were looking at, their stock or their bonds, and, in order to create a market for their stock or their bonds, we would give the managers grief. You'd have to have these investor calls, and we would say, hey, what's going on with this? What's going on with that? What's going on with it? And the managers always would come back and say, guys, I'm trying to implement a strategic plan that's going to take a while. And of course, our rebuttal was, hey, you need to listen to the shareholders. And if you want to tap into this market, which is an endless supply of money, then you're going to need to answer these questions. That's part of the game, right?
Quarterly.
Yeah, I would say that our frustration working in the public markets was, they were fiefdoms with inside the company, and they acted, the agency problem, if you will, they acted against the best interest of the shareholders and used to drive us nuts, either for our investors or someone that was going to put a rating on the stock or bond. If it's not doing you much help as your company in raising capital, it could be a serious hindrance. It is not worth the fact that you're sacrificing the long term for the short term in terms of your ability to execute strategy. So it's got to be able, you got to tap into those markets to raise capital, or it's not worth it, honestly.
Yeah, and I would just add, I think you hit the nail on the head about the long term versus the short term, and trying to find and make sure that the incentives are aligned and that you're doing something that grows towards the long term and not the short term. And it could make sense to go private in that situation where you don't want to, go towards short term goals that may, boost stock price or something, and that's not going to be for the benefit of the company or its projects in the long run. All
right. So on this panel, I got 1 out of 3 panelists' names right. We got through maybe half of my questions that I had ready. So, but I really want to thank you. It was a great panel, great discussion up here. Gary, Phil, and Eric, you guys were just terrific. Thanks,
Thanks, man.
Thank you.